Do not adjust your screen. This is real. The numbers you're about to see are not theoretical. They're not projections. They're not someone's prediction about what might happen next month or next year. These are actual closing prices from trading sessions that just concluded. Silver is back above $81 on COMEX, and it didn't crawl there. It didn't drift higher gradually over weeks. It didn't consolidate and build a base. It lunged. It teleported. Today's move is one of those sessions where the chart doesn't look like normal price discovery. It doesn't look like buyers and sellers finding equilibrium. It looks like a market trying to survive, like a market gasping for air, like a system under stress that's running out of options. And here's the part that matters more than the number flashing on your trading app. Here's the detail that changes everything. Here's the signal that tells you this isn't just another volatile day in a volatile market. Shanghai just closed silver near the high 80s. Let me repeat that with precision, because precision matters. The Shanghai Gold Exchange printed their silver contract, AG T plus D, at 19,495 yuan. That represents a surge of over 7% in a single session. When you convert that number to US dollars using the current exchange rate, you get roughly $88 to $89 per ounce. So while the West, while COMEX, while New York traders are celebrating $81 silver, while financial media is writing headlines about silver breaking above $80 again, the East is saying something completely different. The East is saying that's still discounted. The East is saying your price is wrong. The East is saying we're not selling at your levels. This is the signature of a market entering a different regime. A regime that doesn't follow the old rules. A regime where the playbook from the past decade no longer applies. What are the signatures? Big percentage candles? Not 1 or 2%. We're talking 5, 6, 7% moves in single sessions. Widening global spreads. Not the normal 50 cents or dollar between regions. We're talking $8, $10, $15 spreads that refuse to compress. And a premium that refuses to die. A premium that should normalize but instead persists, instead widens, instead accelerates. And if you're holding physical silver, if you're trying to understand what comes next, you need to hear this clearly. The price is not the headline. The number on your screen is not the story. The headline is the structure behind the price. The story is the mechanism breaking down. The narrative is the system trying to reconcile two different realities that cannot coexist. Because in a normal market, price moves first and premiums calm down. Price spikes, premiums expand briefly, then arbitrage kicks in, supply flows to meet demand, and premiums compress back to normal levels. That's how it's supposed to work. But in a stressed market, where supply is genuinely constrained, where inventory is inadequate, where replacement cost is uncertain, premiums lead and price chases. Premiums expand first because the physical market knows something the paper market hasn't priced in yet. And then price has to catch up violently to close the gap. Today, we're going to break down exactly what's happening. Why silver can rip 5% in a single day and still be behind the physical reality. Why Shanghai's close near $89 fundamentally changes the battlefield and puts the Western banking system in an impossible position. And the 3 specific signals you need to monitor that will tell you definitively whether this is just another spike that reverses in days or a repricing phase that persists for months. A quick disclaimer before we go deeper. This is not financial advice. This is macro analysis and market structure education. I'm not telling you to buy or sell anything. Always do your own research and consult qualified professionals before making any investment decisions. Now let's get into what's really happening. When people say silver teleported, they're describing a very specific market phenomenon called a liquidity vacuum. In a liquid market, there are sellers at every step. Someone is willing to sell at $78. Someone else will sell at $79. The price has to chew through that supply. It climbs gradually. The move is smooth, incremental, predictable. But when the market is stressed, when inventory is tight, sellers don't step in. They step back. They withdraw their offers. They pull liquidity. And when buyers hit the order book, there's no cushion, there's no buffer. Price doesn't climb, price jumps, price gaps. It teleports from one level to another without printing the prices in between. That's why you're seeing moves like this. COMEX silver up roughly 5 to 6% on the day. Not because everyone suddenly became bullish, but because the market is reacting to a shortage of willing sellers at the old levels, because the only way to find the next willing seller is to gap price higher until someone finally steps in. Now here's the critical point. Vacuum rallies don't happen in isolation. They happen when one of 2 specific conditions is true. Either there's a systemic macro bid, meaning risk perception is shifted and capital is driving into safe haven assets, or there's arbitrage pressure forcing convergence between 2 prices. Today, right now, you have both. Both conditions are true simultaneously, and when both forces converge, the move doesn't just accelerate. It becomes self-reinforcing. It feeds on itself. It creates a feedback loop that normal market mechanisms cannot stop. Let's talk about the signal the West cannot ignore. The signal that makes this more than just another volatile session. Shanghai, the Shanghai Gold Exchange, the physical delivery market, their silver contract closed at 19,495 yuan. That's up over 7% in one day. When you convert that to US dollars, you get roughly $86 to $87 per ounce. Some calculations put it even higher. The precise number isn't the point. The point is, you have a massive spread. An $8 spread between Shanghai and New York, between the East and the West, between the physical market and the paper market. And here's what most people watching charts don't understand. When a global commodity trades at two meaningfully different prices, the market doesn't debate it. The market attacks it. Arbitrage capital exists for one reason, to force convergence, to buy where it's cheap and sell where it's expensive until the prices equalize. As long as Shanghai is trading higher than New York, every serious player with global reach will run the same mental calculation. If I can get exposure cheaper in the West, and the physical signal in the East stays elevated, buying the West is the trade. That flow doesn't care about RSI. It doesn't care about overbought indicators. It cares about the spread. And the spread is telling you something fundamental. The physical bid is not satisfied. Demand in the physical market is not being met at current prices. And when the physical bid isn't satisfied, paper price can do exactly two things. It can catch up, with price rising to meet physical demand, or it can break credibility, decoupling completely as participants realize contracts don't represent deliverable metal. That's why the West chases. That's why COMEX gaps higher, because it's being dragged by Shanghai, because arbitrage is forcing convergence, because the alternative is irrelevance. Now let's name clearly what you're actually watching. You're witnessing a two-price market. There's the screen price, COMEX, spot benchmarks, futures quotes, the price that financial websites display, and then there's the acquisition price, what it actually costs to secure real metal in size in the real world where supply chains and financing matter. That is the price to watch. When does replacement cost start to matter? When do delivery times become a real concern? See, in calm markets, the price of a silver contract and the price of actual physical silver are almost identical, maybe a 1 or 2% difference. That's just the normal cost of doing business. But in times of stress, when supply is tight and inventory is low, those two prices start to drift apart. They diverge. That gap, that separation, is the flashing red warning light on the market's dashboard. It's telling you something profound. The market is starting to treat a paper promise and a deliverable bar of metal as two completely different things. And when that happens, the repricing isn't smooth. It's not gradual. It's discontinuous. You get gaps, limit-up moves, and margin shocks that force people to sell, whether they want to or not. You see inventory hoarding as participants refuse to let go of their physical metal. And you see forced buying into an empty order book. This is why panic buying isn't just emotional hype. It's not just retail investors with FOMO. It's a mechanical, structural, and perfectly rational response to a supply-constrained world. The moment buyers believe metal will cost more tomorrow, not because of speculation, but because they genuinely might not be able to get it, the only rational move is to buy now, even at a bad price. Because the only thing worse than overpaying today is paying even more tomorrow, or not being able to get any at all. This is how a premium reinforces itself. It's how you get an $8 spread between markets that refuses to close. It's how Shanghai can be trading at $89 while New York is still at $81. Because those buyers in China don't care about the New York price. They care about getting the silver they need for their solar panels, their electronics, their EV batteries, and their industrial production that absolutely cannot stop. And they will gladly pay $89 rather than risk having no metal at all. Now let's zoom out, because this didn't happen in a vacuum. Silver didn't just wake up one morning and decide to pop. This recent move is an extension of what was already one of the most extreme yearly performances in modern commodity history. Major financial media and bank research have documented it. Silver surged roughly 147% during 2025. That's not a typo. 147% in a single year. That isn't normal volatility or a typical bull run. It's a fundamental structural repricing of the asset, a complete regime shift. So when you see silver rip another 5 or 6% in a single day in early 2026, the question isn't, is this crazy? The right question is, what kind of world creates a market that can return 140% in a year and still gap higher? That world is one where confidence in currency is being openly questioned, where central banks are losing credibility, where money printing is accelerating even with high inflation. It's a world where geopolitics is no longer background noise. It's the main driver of capital flows and strategic resource allocation. Nations are hoarding essential commodities not just for investment, but for national security. And that brings us to silver's dual identity. It is both money and an indispensable industrial metal. This has always been true, but it becomes explosive when both monetary confidence and industrial supply chains are under stress at the same time. You get buying pressure from two powerful directions simultaneously: monetary buyers fleeing, devaluing currency, and industrial buyers desperately securing physical supply. When both hit at once, the price goes vertical. If you want an actionable framework, something more than just watching charts, you need to monitor three specific signals. These aren't predictions. They are tools to gauge the market's underlying structure. Signal number one, the Shanghai premium. If the price in Shanghai stays significantly elevated over Western exchanges, like that $8 to $10 spread we're seeing, it means the physical bid is not clearing. Demand is outpacing available supply. Price hasn't risen high enough to slow things down. As long as that spread stays wide, the pressure is building. If it narrows, the stress might be easing. But if it widens, if Shanghai hits 95 while COMEX is at 83, you're in a runaway scenario. Signal number two, the two-price system. Watch dealer premiums and product availability. When premiums on coins and bars expand while the paper price is rising, it's a sign of replacement cost fear. It means dealers are struggling to restock. Check the websites. If spot is $81 but a coin costs $90, that $9 premium is screaming physical tightness. If delivery times stretch out, if products show out of stock, if dealers limit how much you can buy, the market is telling you the real constraint is physical inventory. When you can see a price but can't actually buy at that price, the screen is lying. Signal number three, volatility plus forced flows. In this kind of market, buying isn't just voluntary. A lot of it is forced. It's mechanical. You have shorts covering because they're getting margin called. You have hedgers who sold forward at lower prices and now have to buy back at a loss. And you have systematic trend-following funds, the big CTAs, whose algorithms are programmed to buy into strength. This creates a feedback loop. Price rises, which triggers more automated buying, which pushes the price higher still. It feeds on itself until something breaks. So here's the key takeaway. This is not just silver going up. This is the market broadcasting a loud, clear message. The global price of silver is being renegotiated under extreme stress. The comfortable balance we had for years is over, and increasingly, the East is setting the price. Yes, COMEX over $81 is a big deal, but Shanghai near $89 matters more, because that's where real buyers show up with real money for real metal. And when Shanghai is trading $8 higher than New York, it tells you the market is not done paying up. Demand is not satisfied. Supply is not adequate. And the price has to keep rising until one of those things changes. Think about the mechanics. For that spread to close, one of two things must happen. Either Shanghai drops, meaning Chinese demand suddenly evaporates, or Western prices have to rise to meet the physical reality. Which do you think is more likely? Is China, in the middle of the largest renewable energy build-out in human history, going to suddenly stop needing silver? Or is the paper price in the West going to finally catch up to the physical price in the East? The path of least resistance is for paper to follow metal. Now, for the big question, won't arbitrage just close the gap? In theory, yes. Traders should be able to buy cheap silver in New York, ship it to Shanghai, sell it for an $8 profit, and repeat until the prices are equal. That's how efficient markets are supposed to work. So why isn't it happening? Why does the spread persist? Well, there are a few possibilities. Maybe it's capital controls, making it hard to get money in and out of China. Maybe it's logistical nightmares. Well, lack of registered metal in the right vaults, shipping delays, insurance costs. Or, and this is the most critical possibility, maybe there isn't enough loose physical silver available in the West to actually execute the arbitrage. Maybe the available inventory on the exchanges is already claimed or encumbered. If traders can't get their hands on enough physical metal to ship and sell, the arbitrage trade breaks down. The release valve is stuck. And if that's the case, the spread can persist or even widen. And the only way for the two prices to meet is for the lower one, the Western paper price, to violently gap higher to meet the reality of the physical market. The market is sending a signal. Let's talk about silver, because what's happening right now is critical, and most people are missing the real story. They see the price moving, but they don't understand the why. On the screen, you see COMEX silver at $81. But in Shanghai, physical silver just closed at $89. That's an $8 difference. Why? Why isn't someone just buying it in New York and selling it in Shanghai for an instant profit? That's called arbitrage, and the fact that it's not happening tells you everything. First, the physical metal isn't actually available in New York at that quoted price. Sure, the COMEX price says $81, but try to take delivery of a significant amount and see what happens. You'll face delays, complications, and difficulties. The price might be real, but the metal isn't easily accessible. Second, shipping and logistics are a nightmare. You can't just teleport thousands of ounces of silver from New York to Shanghai. It takes time, financing, insurance, and permits. If these processes are slowing down, if restrictions are increasing, like China's export licensing requirements, then arbitrage becomes incredibly difficult to execute. Third, financing costs are sky high. To pull off this trade, you need a lot of capital. You have to buy the metal, hold it during transit, and manage all sorts of risks. If financing is expensive or uncertain, that $8 spread might not be profitable after all the costs are factored in. But here comes the fourth and most alarming possibility. Market participants no longer believe they can even execute the arbitrage. They don't trust the system. They don't trust that they can actually buy physical silver in New York and successfully deliver it to Shanghai. And when arbitrageurs lose faith in the mechanism, the price spread can persist indefinitely. It can even get wider. This is dangerous, because if the mechanism that keeps global prices aligned breaks down, you end up with a permanent two-price market. Shanghai trades at one price, New York trades at another, and they never meet. Once the market accepts this new reality, the paper price on COMEX becomes irrelevant. It's just a number on a screen with no connection to physical reality. If we're heading into that world, the real comparison isn't $81 versus $89. It's $81 for paper versus whatever physical costs when you actually need it. And that price could be $100, $120, or even higher. Let's dive deeper into the mechanics of forced buying, because this is where panic becomes rational. Most people think of panic buying as purely emotional, scared retail investors with FOMO. And while that exists, it's not the main driver in commodity markets. The real engine is forced mechanical buying from entities that have to buy regardless of the price. Take an industrial manufacturer like a solar panel factory in China. They need silver paste. Without it, production halts. Workers are sent home, contracts are breached, and the company faces massive penalties. So when silver prices start rising and supplies get tight, do they wait for a better price? No, they buy whatever's available at whatever price is quoted, because the cost of not having silver is far greater than the cost of overpaying for it. That's forced buying. It's not optional. It's a necessity. Now, consider a short seller, maybe a bank that sold silver futures at $70, betting on a price drop. With silver now at 81, they're losing money on every single contract. These aren't just paper losses. They're real margin calls demanding real cash. If they don't buy back their shorts, the exchange will liquidate their positions for them automatically. So they buy. Not because they're suddenly bullish, but because they're forced to. The alternative is getting wiped out at even worse prices. That's forced buying. Finally, think about a hedger, like a mining company that sold its future production forward. They promised to deliver silver at $75. But with the spot price at 81, if they don't have the physical metal ready, they have to buy it on the open market at $81 just to fulfill their $75 contract. They lose $6 an ounce, but breaching the contract would cost them far more. So they buy at a loss. That is also forced buying. When all three of these entities, industrial users, short sellers, and hedgers, are forced to buy at the same time, they create a tidal wave of demand that overwhelms the available supply. This creates a liquidity vacuum, and the price doesn't just rise gradually, it gaps up. It teleports from one level to the next because there simply aren't enough willing sellers to absorb the forced buying. This is what you're seeing right now. This is what creates those 5, 6, 7% daily moves. It's not just sentiment, it's market structure. It's forced mechanical buying pressure that cannot be satisfied at current prices. Now, let's connect this to the bigger picture, because silver doesn't exist in a vacuum. All of this is happening within a specific monetary and geopolitical context. Central banks globally printed unprecedented amounts of currency during the pandemic, trillions of dollars, euros, and yuan. That money is still sloshing around the system. Inflation surged, and central banks raised rates to fight it. But now, they're starting to cut again. Why? Because they can't sustain high rates. Government debt is too massive and the economy is weakening. So they're trapped. They need high rates to combat inflation, but they need low rates to service their debt and support economic growth. They're choosing to service the debt. They're choosing lower rates, which means currency debasement is set to continue. And when your currency is losing its purchasing power, tangible assets rise in value, not just for a little while, but structurally. Then you add in geopolitical tensions, trade wars, military conflicts, sanctions, and resource nationalism. When nations don't trust each other and supply chains are weaponized, countries start to hoard strategic resources. They stockpile and secure their supplies. Silver sits right at the intersection of being a monetary asset and a strategic one. It's been money for thousands of years, and it's essential for modern technology like electronics, solar panels, EVs, and military systems. This combination makes it explosive. You have two different types of buyers, monetary and industrial, who want it at the same time, and neither of them is particularly sensitive to the price. Monetary buyers don't care if silver is $80 or $100. They're trying to escape a devaluing currency. They will pay whatever it takes to get out of paper assets. Industrial buyers also don't care if silver is 80 or 100. They need it to keep their factories running. When both of these powerful sources of demand hit the market at once, price discovery becomes extreme. So, what should you do with this information? How do you position yourself? I can't give you financial advice, but I can give you a framework for how to think about it. If you believe the market structure we're discussing is real, if you believe the Shanghai price matters, that forced buying is happening, and that currency debasement is ongoing, then volatility is not your enemy. Volatility is just the expression of this underlying structure. A random drop from $81 to $75 isn't a sign the thesis is broken. It's just normal noise within a structural uptrend. The thesis only breaks when Shanghai's price drops back to COMEX levels, when the premiums collapse, when physical metal becomes easy to get, and when the forced buying stops. Until that happens, dips are just noise and corrections are normal, but the underlying trend remains intact. On the other hand, if you don't believe in this structure, if you think this is all just a speculative bubble driven by momentum, then you probably shouldn't be in silver at all. You shouldn't try to trade something you think is irrational, because you'll just end up selling at the worst possible times. The most dangerous position to be in is halfway convinced, uncertain, in the trade, but constantly scared. You need to pick a view and commit to it. Either you believe the structure matters and you hold through the volatility, or you think it's a bubble and you stay out completely. Trying to play the middle ground with no conviction is a surefire way to lose money. Let me close with this. Subscribe to this channel and turn on notifications, because we are tracking these signals daily. We're monitoring the Shanghai premiums, watching physical dealer spreads, and tracking indicators of forced buying. We are documenting every single development as it unfolds. Understanding this structure, understanding these mechanics, understanding what $89 Shanghai means when COMEX is at 81, that's more important than any single price prediction. It tells you how to think, what to watch for, and when the structure is strengthening or weakening. And in a market that's moving this violently, having a solid framework is far more valuable than having a price target. Comment below and let me know what you think. Do you believe the West will catch up? Will COMEX rise to meet Shanghai's price? Or will this two-price market get even wider? Will that $8 spread expand to $15 or $20? This conversation matters because our collective intelligence can see things that individuals might miss. Thank you for watching. This is not a drill. Shanghai closed at $89. COMEX is at 81. The spread is $8. And the message is crystal clear. The demand for physical metal is not satisfied. The market is not done paying up for real, tangible silver. We don't guess here. We monitor the data, and we sound the alarm before the crowd understands why. And right now, that alarm is screaming. The regime has shifted. The East is setting the price. The only question is whether you see it before the next phase begins.